Five lessons learned from GameStop.
Yeah, Brian, I'm super excited about this day's show because the world is super excited about this day's show. I feel like you could not have looked at any financial news, media, outlet, website, blog, newspaper, if those things are still out there, without hearing about GameStop, without hearing about Wall Street bets.
And that's probably the first place we ought to start, Bo, is just I think a lot of people have the question, did GameStop break the stock market? Or is this thing just completely off the rails? Because are we now to the point that you need to lock up your family because there's roving bands of Reddit boards where they're just going to drive all stocks, set north, making lots of money all at once, or are they going to come and plunder and all stocks are going to go down? The short answer, none of the above.
No.
And this is, guys, you need to understand how unique this whole GameStop thing was. It's entertaining. I'm excited that Netflix has a movie or whatever docu-series they're going to do.
Is that a real
on it.
thing? I heard that rumor too. Is that real?
Well,
are they really
somebody is going to do a movie. But
already?
here's the thing I would tell you. It doesn't really matter to your long-term finances if you really understand what's going on.
That's
what
right.
we actually have here is a complex tale of greed and a lot of folks that were caught skinny dipping.
Yep.
So, and what I mean by that is, we love the Oracle of Omaha, Warren Buffett, and he has a quote. He says, "Only when the tide goes out do you discover who's swimming naked."
Well, and I think I would say it's safe to say, as it relates to the GameStop specifically, there were some folks out there swimming naked here recently. The tide went out, thank you Reddit, and they were exposed. And they were exposed in a very, very big way.
So let me give you a few of the ingredients, and then I want to talk to you about what actually happened a little bit. So first thing, here's the perfect storm. These are the ingredients that kind of led to this narrative, all the entertainment, the popcorn eating that we all had last week, is that, first of all, GameStop, low market cap. This is not, even though you might have a GameStop in your community, this is not something that's in the S&P 500.
And when he says market capitalization, you can kind of think about that as like the net worth of the company. It's not a huge company. It's not an Apple, a Google, a Facebook. It was a relatively small-sized publicly traded company.
And probably in the cycle of where you are in a business, it's a business that's in the fourth quarter of its life. So short interest was over 100%. That, guys, I'll explain what that means in a minute. There were a lot of smart folks that actually noticed this overreach. And then I think that Robinhood probably had the worst week last week, and they're like, what the heck happened? Because they turned into a tell, and it's kind of ironic. Robinhood's their name, and we all know Robinhood. Iconically, when we read the storybook, they stole from the rich to give to the poor, and supposedly Robinhood, I'm sure that went into their name. They're opening up the markets to everybody. That's what the whole mantra is. And then last week, and I don't mean to laugh, but it is kind of ironic, they shut down the markets to what their folks wanted. But the reality is there was more going on there. It wasn't that they got a phone call that there's this big room, like Deal or No Deal, where a guy from the top goes, "Hey, Robinhood, let's quit.
Shut it down.
Let's shut it down. This is Citadel. We're no longer doing trades." It's actually much more complex. Realize Robinhood, small startup company, grown super fast. And even though we make trading look very simple these days because of innovation, technology, all the things that we all brag about you're taking advantage of, there's still a lot of stuff going on behind the scenes, as we know. You place a trade, even though that money shows up in your account pretty quickly, it actually takes a few days for everything to cross. Well, guess what? The plumbing of that transaction got clogged up because the people that were in the middle said, we don't trust that you have enough assets or money to cover everything.
To satisfy those trades.
It wasn't a hedge fund that called Robinhood. It was more of they didn't have enough money to make it all work. So pay attention to that. I think that tied into it. And let me give you a little peace of mind as we get into this, is that if you look at Home Depot, we found out it's shorted at 0.7%.
That's 0.71% short interest.
Microsoft was less than 0.5%. Yep. GameStop, like I said, was over 100%. So this would never, ever happen with your Home Depots, your Microsofts, your Apples. They just have so much more trading volume. They have such a bigger market capitalization, and they have such a lower percentage of people out there betting against the valuation of their stock. So I don't want you to lose focus on your long-term investing. So, but I just gave a quick overview of why the market wasn't broken. Let's actually give them a little detail, a little more behind the scenes of what actually happened.
Sure. So, like, if you're just tuning in, and perhaps you've been living under a rock, or you've been, out of pocket for the past few weeks, there was some interesting stuff that happened in GameStop. And the very first thing that we ought to think about is if we look at sort of the long-term timeline of GameStop stock, you can see this dates all the way back to, Daniel, this is 1 year ago, right? So this is February of last year. It's not a crazy high-flying stock. I mean, with the axes adjusted, it's kind of sort of flatlining. I imagine maybe even trending slightly upwards there a touch. But then, as we got into 2021 and this year started, you can see something very, very aggressive happened with the price of GameStop stock. And if we kind of like zoom in on that upturn, here are kind of some significant dates that we might want to keep an eye on.
Yeah, and what I think is interesting is that, Bo, you're our CFA.
Sure.
You're our resident smart investment guy.
That sounds like a lot of pressure.
Can you, and we can cover some of these key dates, but can you talk to them about what shorting means? What does it mean when somebody is shorting stock?
In very simple terms, when you short a stock, you're basically betting that the stock is going to go down. So most of us think about when it comes to investing, we want to buy a stock and then we want to own it. And when the stock goes up, we want to sell it for more than we bought it for. That's the way that most of us think about investing. Well, there's another way that you can make money with investing, and you can actually bet that a stock is going to go down. And that's what having a short position is. Essentially, you're borrowing the stock at a price today, and you're going to bank on the stock going down, and when it's time for you to replace that stock later, you can buy it back for less and you'll make the spread on it. So basically, it's a way to make money if the price of a stock declines.
Yeah, so you're basically saying, hey, I think this company's in trouble.
That's right.
Why don't you let me borrow your shares? I'll go ahead. We'll sell them so I get the proceeds, and I promise at some point in the future I'll pay you back. I'll give you those shares back. Now this strategy works great, like Bo said, as long as the stock goes down. And why in the heck were these traders so greedy? Is because, look, GameStop, I mean, when I talk to gamers, we have a few, we all know the staff
point
here.
to the
I look at
entire
Reeve, she's
team.
looking at me. Nobody actually goes to the store to buy, games anymore.
That's right, yep.
You download them now, so you're looking at this like they're paying rent. People don't buy games that way. This seems like an obsolete business model. So that's why I think the hedge fund managers were like, yeah, let's load this thing up. This company is in trouble. Let's see if we can nudge that process a little faster.
Sure.
What I think is interesting is that they got out over their skis. Is that if you think about what happened is that they started betting against the company, saying, hey, we'll do this. And I think in a lot of aspects, they thought, hey, we'll go short. Yes, there's financing costs to borrowing these shares. Yep. But if the company goes bankrupt, we won't even have to pay the shares back. We'll just get to capture the gain and, just basically pay the financing costs. So it seems brilliant. And it was so brilliant that they loaded it up. They were like, hey, if 100% is good, 140% is even better. The problem that this is where I'm so surprised, because these are smart people. People don't actually, you hear about people that were going into rocket science, now go into finance, so they can come up with all these fancy trading platforms and all these other things. Well, I think they got blinded by their intelligence to what risk is, because in basic financial planning, basic investment management, I'm sure in your CFA study work, because I know this was in CFP study work, they explain risk in two components. And the fact that when you buy like Apple stock, the most I can lose is what I paid
what you pay for it.
For the Apple stock.
You can only go to zero. Yep.
Well, here's what I think is interesting when you get into these strategies, these advanced strategies of shorting, is it reminds me of Buzz Lightyear in To Infinity and Beyond.
That's right.
Is because they teach you early on is that your boundary of loss when you're betting against the price of a stock is limitless. It is unlimited risk, and it can go to infinity and beyond.
So we should pause there for a moment. And for you out there thinking as the everyday investor saying, oh, wow, I didn't know that I could also make money on stocks when they go down. I thought I could only make it when they go up. I got to get into this like short stock game. When you start having that thought and start like really trying to figure out how you're going to wade into these waters, remember that the loss equation is very different when you take that side of the trade. it isn't just limited to the money you have at risk. It can go on and on and on.
That's kind of what happened here. Look, it seems like common sense. This is a business that's going out of business. It's obsolete. This is the car just got invented, and these guys are still selling, horse and buggies. So they're thinking, what could go wrong? What went wrong is that some smart folks caught wind of what was going on. They spotted the strategy. They noticed these guys had gotten way outside of their skis to the point that, look, if you're 140% leverage of outstanding shares, you've shorted them. Mm-hmm. If you think about the fact that GameStop is, even though it's a small company, it's only a few $100 million, it was a company that still was held by some of the index funds. Passive strategies and other things. If you're a small cap investor, those shares aren't trading. They're just kind of hanging out. They're not changing. Well, if you take into account that those shares aren't being sold, they're locked in. There's also insiders that are locked in. The actual number of shares that you can actually trade to cover, because remember, at some point you have to pay it back.
Those shares.
And there's also a date certain that you have to pay it back, depending upon what the contract or the terms were. Well, that's what we call a short squeeze, is that when you have, instead of being leveraged at 140%, if you actually looked at how many shares were available, what's also known as the float, we were talking about 300 to 500% of the actual shares that were available, and that's what the smart folks kind of recognized, and they started running it up. They squeezed the shorts. And here's what I think is interesting. The news media was covering this, and they talked about it was a populist revolt, is that we had, just like I said, we're going to have bands of Reddit boards that are going to wreak havoc upon our financial institutions. That's not completely true.
Yeah,
I know it's a
great
narrative. I know it's exciting, and and it's going to probably play out very well in the Netflix movie. But the reality is that it didn't really play out that way. If you looked at the trading volume all the way through Thursday of last week, only 29% of the trades were coming from retail platforms.
And when we say retail platforms, you can think about that like the everyday investor, the stuff you keep reading about in the blogs and articles, and the folks who made hundreds of thousands of dollars overnight, and all of a sudden mom and pop are now, mom and pop war bucks. That was not the majority of folks who were participating in these trades. It was a lot more institutional money and a lot bigger players than just retail investors.
And if you need more proof, look at the aftermarket trading. I mean, this stock, the market would close. The typical trading day is 9:30 to 4 p.m. Eastern time. Well, you'd see aftermarket trading, and it would be 30%, 40% swings. That's not mom and pop retail investors either. That's big movements. And by the way, don't be surprised if some of these swings people weren't playing both sides, meaning that, yes, hedge funds got caught predominantly, but don't be surprised if it wasn't other hedge funds that weren't squeezing other, because this isn't like they're all banded together behaving in one way. There is, when you smell blood in the water and you see that these people are squeezed, they have to cover. You know that there is ways to squeeze the shorts.
It's not like this one guy on Reddit figured this thing out and he was set to make all the money. As soon as this thing started catching momentum, there were other smart players involved that saw the same opportunity. Unfortunately, when it comes to those kind of financial matters where there's money to be made, they're going to go out and try to make that money.
And I feel like I have to mention my man, Elon Musk. We all know I love Tesla. I love Elon. People are like, why in the world, in the middle of all this drama, was Elon Musk tweeting about this?
Yeah.
And most of you guys, because you're financial mutants, you get it. But I feel like for anybody who just stumbled across this, if you want to know why Elon was in there, Tesla has been one of the most shorted stocks in history. And I think Elon doesn't like shorters.
Because it's basically a bunch of people betting on your failure. It's a bunch of people saying, no. This thing that Elon Musk is doing, it cannot sustain. It's not real. I'm going to bet that it's going to go down because it has to go down. Well, that'd be pretty offensive to me if I were the CEO of a company, and that's what people were saying to me about my company.
I mean, Elon hates short sellers so much that he even sold on the Tesla website in the store shorts. He had these things. They're a little cheeky, so we won't show them because I don't know if they make it onto our family-friendly show. But it is one of those things. So that's why he jumped in. I don't think he was necessarily out there making money. He doesn't have a position in that. But I think he was kind of piling into the part of, hey, if these guys who are shorting, who are betting against, I kind of like seeing that. And I think he was having a little fun. But here's what I want to try to transition this to. I want to talk about the 5 things you should actually learn from this experience, because there were definitely some teachable moments, and this will hopefully keep you on track. So not only were you entertained, but you didn't lose track of what you actually should be doing with your money. So here's the 5 lessons to learn from GameStop last week.
Now, the first one, and I want to say that maybe this is the big one because, I mean, everyone got excited about it. What I think is crazy is normally, my social media is filled up with, like, political stuff and kid videos and pets and all this stuff. And it seems like very quickly it all started talking about GameStop and all started talking about this Wall Street Bets thing. And it was people who I've never even heard make mention of money were now wading into these waters talking about how they were going to go buy it up and buy it up and buy it up. And they thought that they were doing something that they weren't actually doing. And we want you guys to not make that same mistake because we want you to understand the difference between investing and speculating.
Yeah, and I think the sad part of this whole story is there's going to be people, because the people who are going to be left holding the bag are the ones that say, free money, I want some of that. Yep. So they're going to go jump in. They're going to lose 50%, 70% of their money because they get in, they're left holding the bag. And they'll for years, decades, they'll tell young people, that investing, that thing is rigged. That's rigged. Horrible. Let me tell you a time I lost 56% of my money in 2 days because I invested in this stock called GameStop. That will be the story. But what people don't understand, speculating is straight up gambling.
That's right.
Whenever you hear people compare the stock market to casinos, they are no doubt talking about speculating. That's not what we want you doing. When we're talking on the Money Guy Show, we are long-term investors. I don't want you putting anything in any market that you can't walk away from for 5 to 7 years. We've even done shows where people talk about engagement rings, house down payments, and I'm like, look, I don't care if it's 3 years away. Needs to be liquid, needs to be safe, because you don't want to have to worry when I need that money, is it going to be available to me? So that's speculating. Everything we saw last week had nothing to do with fundamentals, had nothing to do with price-to-earnings ratios, had nothing to do with is GameStop innovating or coming up with a better way to make money for its shareholders. It was all about, hey, there's this cool game going on. Let's go in, get in and have fun. No different than the roulette wheel, no different than anything else that's basically straight up speculating and gambling. So let's talk about investing. Because, when I talk about gambling, there's usually a deck of cards involved.
Sure.
And I want you to know, investing, the deck is stacked.
Now, I want to stop you right there. Because we love you, our Money Guy family. But even as this live chat is rolling, a number of you are saying, you know what? The game is rigged. The deck is stacked. Oh, it's the fill in the blank of the people that you think are stacking it, but the deck is stacked. It's rigged. It's all set up. And we're here to tell you that's true.
It is. I mean, it is completely stacked, but guess what, guys? This is the good news. If you're investing, not speculating, if you're investing, the deck is stacked actually in your favor. Mm-hmm. We pulled this. This is actually, I saw this on Twitter last night, but it's from Dimensional Fund Advisors. Yep. They had the S&P 500 from 1926 to 2020, and I thought this was so interesting because what I just talked about is I don't want you investing unless you can walk away from the money for 5 to 7 years, because you know what the most important component of that discussion was? Time. You've got to have time to let the economic cycle, let businesses innovate, let the growth of the economy occur so that you're not just trying to choose a point in time and capture what happens in the next week, what happens in the next 2 months. No, you're capturing what's happening in the general economic cycle. And by the way, in the long term, that's great. And here's the proof of that. Daily, you can see 56% of the time, the S&P 500 positive.
So it's a little better than half. But if you were someone who's thinking about investing on a day-by-day basis, that's kind of a scary proposition. About half of the days I'm going to make money and about half of the days I'm going to lose money. And so I get why in your mind you think, oh, well, the folks who just have more information or in the know and on the inside, they're the ones who can make money day trading. Because it's not an incredibly attractive proposition to think about. I only have a slight edge over 50-50.
Go out to 1 year.
Okay.
Because this is what we always talk about. 8 out of 10 years or 7 to 8 out of 10 years, you're going to make money in the stock market, and here it is. You can look, if you go out to 1 year at a time, 75% of the time, financial markets are up, specifically the S&P 500.
So you would never do this, but okay, if you're a day trader, you're thinking, okay, maybe one day I'll make money, one day I'll lose money. Well, if you're a year trader, I've got to think about like how you would actually do that in practice. but about 3/4 of the time you're going to make money. If you're only investing on a year-by-year basis, about 3/4 of the time you're going to be positive.
And then we spread it out to 5 years. Remember I said 5 to 7 years. 5 years, look at this, and I love the number. 88% of the time. We talk about 88 times over all the time, but 5 years, now you're 88%, getting close to 9 out of 10 10 years, you're going to make money as long as you kept that money in the market for 5 years.
And then when we go on to a full decade, for 10 years, and these are 10-year rolling periods, all the way, remember, the Great Depression was even in this time frame, as well as the Great Recession and the quote-unquote lost decade. 95% of the 10-year rolling periods for the last 100 years have been positive. If you could just let your money work for you for a decade.
And by the way, this is a fully 100% equity portfolio. I could show you where if we just added a little bit of diversification, I could actually get it to 100% on a rolling 10-year period just by adding a slight bit of diversification. This is why we do this, guys. And then 20 years, there has not been a rolling 20-year period from 1926 to 2020, taking into account all the horrible things we've experienced in the last 20 years. The dot-com, terrorist attacks of 9/11, the Great Recession, a pandemic. There has not been a 20-year period where we lost money if you just stayed the course.
Now, Brian, personally, and you know this about me because we hang out, I don't like losing a lot. Like, maybe it's like from childhood when I was in athletics, I just don't like losing. When I think about folks who'd like try to day trade and try to go out and participate, that maybe a little over half the time you win, but half the time you lose. What I love about investing is if you want to talk about the deck being stacked or the game being rigged, if you can give yourself a long enough timeline and you can have the appropriate risk in your portfolio, it is rigged, and it's almost set up to where you, quotes here, can't lose. If you give yourself a long enough time period, odds are you're going to be successful, and you don't have to be that clever. You don't have to outsmart the system. You don't have to figure out something that other people haven't figured out yet. All you have to do is just show up and stay consistent, and you can set yourself up for long-term success.
Guys, it's also, you say, what's the magic? What's driving this? Is something changing that maybe this worked in the past, but it's not going to work now? Here's what I tell you. Do you think innovation is slowing down or speeding up? And that's why I think a lot of people as humans, we think very linear. This is actually growing exponentially. So if you think about the fact of what I've experienced in my 40-plus years of life, what I will experience in the next 20 years will probably be even more than the sum of those first 47 years I've been on the planet, because we are seeing the rapid innovation of what's going on. There's going to be ways to make money off that. There's going to be ways for you to invest in that ever-changing world that don't get excited about that. That's not something to be upset about. That's not something to be pessimistic about. That's something that you can ride the ride and also be part of this ever-expanding economy that we have.
Okay, so lesson number 1 was know the difference between investing and speculating. Lesson number 2 is to keep wealth, don't become overconfident. Now, you notice that we don't say, we're not talking about those that are trying to accumulate. We're talking about for those that have done a good job of building wealth and have reached a certain level of success. Don't be overconfident. Don't think that you can't lose. Don't think that the rules do not apply to you.
Well, I can, specifically this GameStop situation, I can almost visualize the meeting where, if you could, every action movie that has like crime bosses and stuff, they always meet together and they're always, it's kind of like the Legion of Doom type moment. I have this visual of all these elite investors that are hedge fund managers meeting in a room. And like, guys, well, it's kind of like an investment club for the evil villains that are short sellers. And they're like, guys, I got one. I got this company. I mean, this business is horrible. They have all these retail locations. They're paying rent. Nobody's doing business this way. Let's go crazy. And, and that's the thing. But they had overconfidence.
Absolutely.
They had a lot of these people have wealth, and they just lost that key rule of understanding. There's a tremendous difference between losing what you invest versus losing to infinity and beyond because you have unlimited risk. And they definitely got overconfident, overplayed their hands, and now they're paying the ultimate financial price for it.
Now, you're probably out there, you're thinking, well, I'm not a hedge fund manager. I'm not thinking about shorting stock. How does this actually relate to me? I can think of a few ways really quickly. Maybe you say, you know what? I got a really healthy income. I don't need emergency reserves. I mean, my cash is paying nothing. I don't need that 3 to 6 months in cash because I got enough income.
Or you have home equity. By the way, I'm looking at myself with this mistake is that I have done this. I was like, why do I need cash reserves? Cash pays nothing.
Yep.
I got this beautiful home over here with all this home equity. They'll even give me a checkbook or a debit card to pull right off of that. No, that is overconfidence. Pay attention to those things. There's something to be learned from that. Number 3, pay attention to who you choose to help you with your financial decisions.
Yeah, this is a big one because a lot of the flack that got thrown out was because Robinhood made this decision or perhaps their hand was forced into having to halt trading. Well, a lot of folks thought, Robinhood's going to be where I build my wealth. I'm going to put my money out there, and I'm going to be able to do these things. Well, truth be told, Robinhood as an entity was not equipped to handle the kind of volume that the GameStop trades were requiring. Now, there were other institutions, a lot of the big boys out there, that had no problem handling that volume. So when you choose to put your dollar somewhere and you want to implement a strategy, make sure that where your dollars are match what your strategy is going to be.
Well, I mean, think about this. I mean, if you have your cash savings and they're over 6 figures, are you going to the upstart bank that doesn't have FDIC insurance, or are you going to the bank that has FDIC insurance?
Yep.
I mean, that's what I think
Great
that
point.
people got a little carried away. I've done this also in business. Do you invest in the software that's a third of the price of the company that's been around to manage all your financial stuff for your clients? Or do you go with
pay
a
the
tried
extra,
and true business that's been around? I've been burned by going with the startup. And I get, look, a lot of you young investors, this is exciting. You have a company that said, we're not going to charge you anything. This is no commission, no cost trading. You realize you are the product if that's the case.
Right.
If they're not, how do they make money? It's because they're using you. They have the hedge funds betting against your trades. They have the volume of the trading. They're making profits off of that. They're also selling data on all the information on you. There are ways that they're doing it. But in the grand scheme of the business of actually moving financial assets around, they were newbies. And they kind of fell into some risk exposure that they got caught with.
Yep.
And that's something, I'm just telling you, with something so important as your financial independence, your financial security, maybe make sure that it's going to be here. When we're pricing life insurance or other things, you ask yourself, will this insurance company have the financial resources to pay this if I actually die prematurely or I get disabled? You kind of need to think about that when you're dealing with financial institutions to hold your money as well. So pay attention to that.
Number 4, understand risk and when you have won the game.
Bo, this is one you made fun of me this
Oh,
morning.
I made a lot of fun of you.
Because I come in on
this
these
one.
shows and I say, I've got an idea. We need to cover this. And Bo goes, oh my gosh, we haven't used that slide in probably 7 years.
At least we created it 14 years ago, possibly.
So this is I want you to understand risk when you've won the game, because I think this is something we help clients with all the time. They come with us and say somebody made their money in real estate as a developer, or say somebody was a small business owner. They're a cowboy. They love risk, not scared. I talk about risk tolerance. Like, I don't care. I started a business. I'm successful. What do I care about risk? I'm like, that's risk tolerance. We're talking about risk capacity, because it's not only how you made your wealth, it's how you're going to keep your wealth. And here's what I like to show people. Look at this. This is why math is fun. If you have a kid that tells you, I don't like math, just show them this slide and be like, this will show you why math is fun. It's because
this is how we're going to win the kids.
No,
to
because
math.
look at this. When you lose 10%, you only have to make 11% to make it back. That's kind of cool. But here's where it gets even cooler. If you lose 50%, you have to make 100%. You're like, whoa,
sounds a lot harder to do.
Wait a minute, I kind of get that. So, just what I lose actually changes the return, and it's exponential.
Yep.
I mean, that's a big thing to learn. Now, look, I know this is not perfect, because we know markets are not linear. They don't make 9%, but it definitely makes a good point of understanding risk capacity, is that if we had a market that makes 9% in incremental levels, assuming you lose 10%, it only takes 1.2 years to get your money back.
Yep.
If you lose 50%, potentially it could take over a decade.
Yep.
And this is what I like to show older investors. It's not about making money. It's also keeping money. And I think sometimes people don't understand what they're doing with the risk. So you got to understand what risk means and how you actually keep your wealth.
So when you have won the game, or when you are rounding third base and you're heading home towards financial independence, make sure you're giving yourself a really solid assessment of, is my portfolio structured the right way? Is my debt or lack thereof structured the right way? Do I have the appropriate emergency reserves? Are you checking all the boxes to make sure that not only you win the game, but you keep the game won for the rest of your life?
That leads to our last point. Never invest in a business you cannot understand. That's actually a quote. Mm-hmm. It's from the Oracle of Omaha, of course. What's funny is Bo had written another person's name on there.
I thought it was, but I'm sure that guy. There was a guy. He was like, I don't know. I'd call him like the Magellan of the old days, and he had this quote, but I guess it wasn't him. I guess it was Warren.
That's what I find is interesting. We go and type in the quote we know on Google. And it always comes back as Warren Buffett.
If it's finance, it's always Warren.
So I thought that was, but there is something to be said about, because Lord knows, guys, watching the mainstream media cover this, even the financial media, are like, oh my goodness, do they know how markets work?
Nope.
I mean, no. Look, news is all about keeping you focused. They're selling the time in between advertisements. That's how they make money. So they've got to keep you engaged. They got to keep you entertained, but they don't have to educate you. That is not. They're not worried. That's the dirty little secret of all media, whether it's print, whether it's TV, streaming, is that they are selling their access to sell advertisements. So you are the product, your attention. So they don't care about your wallet. So pay attention to what you're investing in. This was complex. This had a lot of components to it. Had a lot of narratives that were entertaining but not necessarily true. And I think it kind of took people's eyes off of what the purpose of investing is and why you have to focus on doing what you understand.
Yeah, it frightens me a little bit because I have people that say, hey, you know what? I don't understand this whole Bitcoin thing, but I went and bought some and I made some money. And hey, I don't really understand what's going on with GameStop, but you know what? I went and bought some and I sold it and I made some money. And that's great. I think that's awesome. What I would argue you were doing is you were speculating and you got lucky. Do not confuse being lucky with being an astute investor, because astute investors understand where they're putting their money and what they're doing with their money. And we have another quote.
I think you attributed this one to Benjamin Franklin.
I think it was Benjamin Franklin that said this one. Even a blind squirrel can find a nut every now and then. If you're someone who you just happen to participate in the Bitcoin thing thus far, or participate in the GameStop, and you didn't really know what you were doing, but your uncle's brother-in-law's cousin's best friend's sister told you ought to do it, and you did it, and you made some money, I wouldn't argue that you made a sound investment. I would argue that you got lucky and you speculated well. I don't know that that's how I would try to structure my entire financial life.
I love that. If you don't know who said something, just say Benjamin Franklin.
That's it.
It works out every time. Guys, a lot to be learned last week, a lot to unpack. But I think hopefully we could shed some light on the fact that don't lose focus. Know your why. Know why you're investing. Know the power of your army of dollars. Make it work. And don't let this stuff, let it entertain you, but don't let it distract you. Let's answer some questions.
All right, so we're going to give you guys, as you know, one of the things we want to do is we want to perpetrate the abundance cycle here. We like to answer your questions. We tell you the things we think that you ought to know about, but sometimes say, hey, I want to know about this. What do you guys think? So we're going to go into those. So this first one is from JM, 248198, if you want to know the whole screen name. If I'm only planning on being in my house for another year, should I continue to pay extra on my mortgage, essentially get the equity up, or save the money in a high-yield savings account for my next down payment? And I feel like people ask this a lot. Hey, I'm moving. Should I keep paying the extra on my mortgage, or would I be better off to put that money in a high-yield savings account? What are the kind of the pros and cons to each of those decisions?
Well, I'm going to assume JM has, I don't know what his or her interest rate is, but for some, it's probably low. I mean, I bet it's less than 3%, or definitely less than 4%. And yet a move is coming up in 12 months. That's definitely short term.
Short term for sure.
And having moved 3 times in my life, here's what I know. Things always cost a little bit more when you're buying a new house. There's always fees and costs that you didn't expect. And then you're going to go to Target or Home Depot at least 3 times after you move wherever you are, and you're going to spend more money than you anticipate even with doing that.
Yep.
All this to say, you're going to need more liquidity. You're going to need access to cash. I think, look, I love the fact of prepaying mortgages, especially if you're over 45, because I want you, as you get over 45, as your army of dollar bills are already working for you because you built that foundation, it's okay to prepay some of that debt because so you hit independence, financial independence, completely debt-free. But if you know you're moving in the next 12 months, what you don't want to get in a situation is you prepaid that mortgage, you have trouble selling the house,
That's right.
and you get squeezed when you actually need the cash.
Yeah, I have a lot of folks, they always make this argument with me that, oh, I just hate throwing away money in interest. I hate throwing it away. And we get the same argument with rent, too. I hate throwing away money with rent. When you're making big life decisions, like moving and buying houses or selling property or whatever, flexibility is valuable. And while you may pay a premium on interest or while you may pay a premium on renting, keeping flexibility on your side of the equation can be more valuable than you think. So, JM, in my opinion, if I were you about to move, I think I'd put that in a high-yield savings account rather than paying down the mortgage.
Well, really, if you think about it, cash is like oxygen. Mm-hmm. We all take it for granted until you don't have it.
That's
and that's the thing
right.
when you're making a big life
analogy.
decision like that. I mean, we all take for granted that life is good, things are really going well, but all of a sudden you go underwater, and you're like, holy cow, I can't hold my breath half as long as I thought I could. You always want to have that buffer, that margin to get you through some of those big life events.
That's great. All right, this next question is from Connor. And Connor said, after employer match, should my wife and I max out 2 Roth IRAs or go back to 401k after the first IRA? So I'm doing my employer match. We're going to go do on Roth. Should we do both of them or should we just do one and then go back? I wish there were it's a hard question, right?
I wish there were up my things.
I wish there was an instruction manual on how to approach that.
We have the financial order of operations, and it's almost like there is a system that explains this. First of all, number 2, employer match. Great question.
So he knows he's supposed to do that first.
He's asking, should we go Roth or max out retirement? If you notice, that's 2 going to 5 or 6. What happened to 3 and 4? We feel like we have some steps in between.
Hopefully he did that. Hopefully he doesn't have any high interest debt. He's got no credit cards. He's not doing that.
Got to check the list.
And hopefully he and his wife have already filled out their emergency reserves, whether it's 3 months or 6 months. And so now they're in the accumulation phase trying to figure out what to do next.
So assuming that he did make the stops at 3 and 4 and checked the list off, he didn't have credit card debt, didn't have student loans that were high interest, and he had emergency reserves, then here's what I'm trying to decide between, do I go Roth IRA, do I go employer Roth account? There are a few things. And actually, I want to give credit to Bo, because I think sometimes, the easiest thing is, hey, just put a little bit more in that employer 401k. You can do the Roth options. It'll be great. It's simple. You're already there. You got an account open. But there, you are leaving a few things on the table if you go that route. First of all, with a Roth IRA, and we kind of whisper this because it's one of those features that's a little scary.
Never want to have to use.
If you fund your Roth IRA, it's actually kind of an emergency fund. If you really got in oh my goodness, I'm in a pickle of a situation, where can I get access to money without creating big taxes, big penalties? You can get access to your basis in your Roth accounts. I don't want you to do that because that tax-free growth is so powerful, but it is a fail-safe. You can't do that with your 401k necessarily. You can take a loan, but loans, they have their own provisions and some risk that's not worth going into right now, but know that it's just easier with the Roth IRA. Also, Roth IRAs, you get to choose who you invest with. With your Roth 401k, there's a chance you're at a good place. Maybe you're with one of those big providers like a Vanguard or Fidelity Investments. Good on you. But a lot of you that are with small businesses, you don't love your provider of your 401k. With your Roth IRA, you get to go choose who you work with. So you can go choose those better investment companies that have the low-cost index funds. And you control that. And here, if you're getting older, you're starting to worry about required minimum distributions once you're 72. With a Roth IRA, there are no required distribution requirements, whereas your Roth 401k or 403b might have some distribution requirements still. So that's why we would probably, we'd recommend the Roth IRA over your employer. Now, it doesn't mean, look, there's a whole nother level to this game. If you have a big enough shovel that you can afford to fund it with your income, I'd love if you're disciplined and your income is below the Roth IRA income limits. I'd love for you to kind of do both, but I know that's asking a lot. I know that's asking a ton. That's probably for those fire folks that are getting into 40, 50% savings rates. I try to give you, Bo and I try to give you the freedom. Once you save 20 to 25% for the future, you can move on to the next step. But it is something to at least understand and know.
Love it. All right, this next question is from Rob. Rob is a faithful follower. I see your name a lot, Rob. Thank you for always being here. He says, where, if at all, would you rank a company's 401k plan into a decision to join or stay with a company? Was recently looking around until I found my company's 401k match was the best. So I'm trying to think about jobs and changing jobs and that sort of thing, and like, how do I weigh the benefits? Well, obviously, one of the things we always want to think about when it comes to working a job is the total compensation package. You know, what does time off look like, and what does health insurance look like, and what does 401k look like? And one of the things that employers try to do to really entice top talent to come is offering really good benefits. You know, some people even call them like golden handcuffs, depending on what the benefits look like. And we're unashamed of this. That's something we do. We have a very generous 401k plan at our company because when someone is entertaining the idea of coming to work with us and join the Money Guy team or the Abound team, we want them to get really, really excited about that. It is an incentive that we offer to get people to come here. Now, would I look at a really good 401k that has really generous matching, but it's like a horrible job that I'm just going to bite my fingernails on every Sunday and I'm just not going to enjoy doing it and it's not going to be fulfilling and I got to sit in like 3 hours of traffic every day? Probably not. In my hierarchy, I would probably go like quality of life. How does it work for my family? How does it affect my long-term career trajectory? And then if I have a couple of different options that all fit those criteria, probably the next tier I'm going to go to then is the benefits package. What does retirement look like? What does health insurance look like? What do those types of things look like? Is it a company that's over a bakery? Because that'd be awesome. Those sorts of things.
Well, I definitely think it should be on your T column of pros versus cons. And, you know, that's an accounting
He just
term.
threw out T column.
I mean,
how does he throw out T column and T column answer?
But here's what I also think is that you might be. I'm going to give you the Bo Hansen glass half full perspective. Bo and I have been working together we're in our second decade now. I know when I hired Bo, he just assumed, because he had heard from a professor in college, that, you know, if you go work with an old enough boss, you can eventually take over.
That's the deal.
So I think, you know, because you always, I can't remember was it Iris? You always said
Iris,
the story
right, yeah.
that you could have gone to another firm and just taken over the firm in 3 years.
She only had like five good years left in her working career.
It didn't. So there is a chance if you have the right opportunity and you think you will be the right stakeholder type employee, because we talk about this all the time. I want you to be an advocate for your retirement plan. You might be able to come in, explain to your employer the benefits of switching to a new retirement. Right. You know, because this is something I've been trading a bunch of tweets. I guess I said that right on Twitter, where we've had a listener.
We've been tweeting back and forth.
They were sharing. They were like, "Why doesn't my employer offer mega backdoor Roths? Why don't they offer Roth?" And I was like, "Look, a lot of times employers." It's kind of a set it and forget it. They don't realize how simple it is to go restate the plan, just pay a quick fee to update the plan document and do it. Maybe you're that advocate for change. So that's the glass half full perspective, because that's what you would do. You would nudge me until we made something happen.
And look, sometimes there are reasons that are outside of your control, but I think more often than not, it really is set it and forget it. So if there's something you don't, and it can be something simple like, hey, why aren't there like really good investment options? Hey, I'd love to have this thing in there. Hey, why don't we offer Roth? Because that's what we see all the time. Someone has a 401k that's just been offered forever and they don't have a Roth 401k provision. That's a really, really easy thing to add. Well, if you and maybe you get a colleague or two to also write HR and say, hey, can we add Roth? You might be amazed at how much power you have.
Can we add index funds? Can we add index target retirement funds? Roth, these are all really valuable benefits you ought to add to your retirement plan.
All right, this next, since we're talking about 401ks, this next one, I'm actually going to combine 3 questions because we're all kind of in the same frame. And this is like a little, it's sort of nuts and bolts. And what's funny is 2 of the questions are the exact same almost, except for they come from 2 different people. So I'm pretty sure that Tim might have just gotten a different screen name to ask multiple questions to see if it increased his odds. Because here's what, I'm just going to read all the questions to you and you're going to figure out the answers. number one, what's the penalty for contributing more than $19,500 to your 401k? I'm going to assume that this person is not over 50, because if you're 50 or over, you can do $26,000. And then a second person said, hey, what's the penalty for contributing more than $19,500 to your 401k? And then two, should the 401k be Roth or traditional? So what's the penalty? How do I decide? And then here's another one that ties in with this. Hey, my company failed the non-discrimination test for 401k. What should I do with the money? So there's a lot of stuff in there, but it's so all in the same vein, I'm going to combine all three of those questions.
All those questions, except for one of those, kind of make me cringe just because coming from my accounting background, tax preparation, and it cracks me up. I was talking to one of my great clients. This is at the end of last year, and there was an overfunding situation. And he goes, yeah, but the provider says it's no big deal. They'll just reclass it and restate it. And I was like, yeah, it's no big deal to them, but to you, the ultimate participant, you, the ultimate taxpayer that has to file a tax return on this is going to be a nightmare if you don't fix this before we cross 1231. And that's just coming from my tax preparation background, doing that for 16 years. I know what a complete disaster it is when you overfund retirement plans. So look, penalty is not the right question. Uncle doesn't let you keep the money there. Nope. What the government does is they make you essentially pull that money out, calculate the gains, reclass it back. You will pay taxes on it. But you'll also pay probably a lot of preparation fees, is because you have to, if they did this in your previous tax year, you have to go amend the prior year's tax return, which is, oh my goodness, it's just a pain.
It's a big mess
for something that was such a simple mistake. So that's why anybody, and I'm going to let you fill in the gaps, but I think the guidance I tell anybody, because we have clients that are in these situations, if you know your employer's plan is structured in such a weird way, by the way, go modernize your retirement plan so you don't have these issues. But if you know that they are restricting highly compensated, first of all, they should go redesign their plan, because there's safe harbors and other things that you can do to get around that. But the second thing is, you probably need to work out a safe level of funding. And I hate to tell you to do that because you're leaving some money on the table, but you do not want to get into a restatement situation every year, because your accountant's going to hate you. You're going to hate going through the experience. And it's just not a very productive endeavor to be involved with every year.
Now, here's the good news as it relates to the 19.5 limit specifically, and then I'll speak to the highly compensated piece. Most plans have automatic shutoffs. Yeah. Most plans won't let you contribute over $19,500 if you're not eligible. Now, keep in mind, some will make you, even if you are over 50, they'll make you make an election specifically for the catch-up contribution. Don't just assume that once you fill up your 19.5, the 6,500 is also going to get filled up. Sometimes you have to do that separately. But most plans will have an automatic shutoff so that you can't overfund, except, and we see this all the time, if you change jobs intra-year. Yeah. Say perhaps you worked for one company for January through June of one year and you contributed half of your 19.5. Well, then when you go start with your second company, they're not going to necessarily communicate with the first company to know that you've already put in X amount of dollars. So in years that you change jobs, you always want to make sure that you monitor it very well, because if it turns out that you did overfund, just like Brian said, you have to do a return of that excess contribution. You have to pull out any applicable earnings. The earnings are going to be taxed. If you're under 59.5, they'll be subject to penalty as well. There are some things that happen if you go over that. So the time that you really want to make sure you are very, very careful of it is in the years that you change jobs, because that's when you're most likely to get bitten. If you're someone who's highly comped, I do agree. Here, it's hard to paint this, because what they have to do is every year a 401k does annual testing to determine if they're going to have to refund contributions for highly comp folks. Well, one year they might have to return $1,000 to you. The next year they might have to return $17,000 to you, because it's all dependent upon the employee census. So what I would try to do is change your plan. That's really
restructure the plan.
I would try to restructure the plan so that your highly comp folks don't run into that scenario.
The other thing, because you just said something, I've run into this a good bit with our clients, is even with our own 401k. What happens if you hit 19.5? Because you hit the fail-safe, it stops funding you. You hit 19.5, say in September. Do you lose out on match?
It depends on how the plan is structured, which is so frustrating. Now, this is something that we did not realize until we realized it, until we actually had this happen in real life, that a lot of plans are set up that, say you get a big bonus in March, and because that bonus comes through, it maxes out your 401k. A lot of plans are written that you only receive the employer matching contribution in periods in which you contribute to the plan. So even though you did 10% contribution to your 401k, if you weren't contributing the rest of the year, you could be missing out on that match. So you want to check to see if your 401k has an employer contribution true-up provision written into it. Though that's the language you want to ask HR to make sure you're not missing out on any employer match.
And look, we're only in the second month of the year. You might want to just make sure you're doing, like for 19.5, it's $1,625 a month. It might be in years that you have these problems that you overfund because maybe you're a commission-based, your sales. Put a dollar amount instead as a percentage of your income. And it's the same thing with the catch-ups because we've run into that too, is that a lot of plans, you're over 50. You plan on getting all $26,000 into the retirement plan for the year. They stop at 19.5. You're like, where's my catch-up? You might have to go in there and separately elect to fund that catch-up contribution. So pay attention to those things.
This next question is from Eric. This is a good one. If there's a chance that my gross income will be greater than allowed for Roth IRA, so I think for single, you know the income thresholds, should I wait to contribute, wait until after the year, know my income, or should I go ahead and start the backdoor process? So if I'm someone that's on the line, right, should I wait and just contribute directly to a Roth, or should I do the backdoor? My answer is that it could really go either way. There's not a downside to one or the other. I guess technically you could do the backdoor earlier so you could have that money working for you more quickly. But here's what you need to make sure of. There are some things that have to be in place to make sure that a backdoor, a Roth conversion strategy is applicable to your situation, like you don't have other IRA assets. If you have SEP IRA or simple IRA or an old IRA rollover sitting out there, and you try to perpetrate this Roth conversion strategy, what you think or what you thought was tax-free may end up actually being taxable. So if you're someone who has a poor account structure and the Roth conversion would not be tax-free for you, then I would certainly wait till the end of the year, see what my income was, and see if I could do Roth.
I've actually had some very smart people, brilliant people, but they get so excited, they're financial mutants, they get so excited about this backdoor Roth contribution that they overlook that you better not have any other IRA assets. I'm talking about rollover IRAs, I'm talking about traditional IRAs that don't have basis in them, I'm talking about simple IRAs, I'm talking about SEP IRAs. You cannot have any other IRA assets because I've had financial mutants that they hear about this Roth conversion strategy. They are in higher income situations. They go to town. They're doing this every year. They're even talking to their CPA, but their CPA doesn't even know what a backdoor Roth is. So
never heard of it.
That's fine because this is kind of a self-reporting thing on your 8606. And they don't do it. And then you wake up 5 years in the future and you talk to somebody who understands how this all works, and you're like, you've got a tremendous problem here. You just really screwed this up. So make sure if you are doing the Roth conversion strategy, also known as the backdoor Roth, make sure you have all the components. Don't screw that up. That's one of those things where you might want to graduate through the abundance cycle, work with somebody that can check the boxes like what we do for our clients. If you are a person that's right on the cusp of exceeding that income threshold for Roth accounts and funding, then yeah, I think that you do wait. I hate that you're leaving up that opportunity cost of the previous year, but you do have until April of the following year to fully fund your Roth account. It's better to know where your income comes in than to have that oopsie and have to restructure and scramble. I think that's even greater than the opportunity cost lost.
Yep, love it, love it, love it. This next one, this is actually another friend of the show. This is Dax. Dax says, annual bonuses and commissions. Advice on investing lump sums? ? Also, does the guidance change if the bonus commission is six figures versus like $20,000? Yeah. So if I get a big commission and I want to invest, or I get a big lump sum, or I get a big bonus, should I invest it all at once? Should I dollar cost average? If I dollar cost average, how long should I dollar cost average? And at what thresholds does it make sense and not make sense?
Yeah, we know. We've covered this before, and I think it's worth noting. We usually, a few trolls will crawl out, so I'll try to make it nuanced enough so that they feel like I paid them respect. But it is one of those things where we know, and I've showed this stat before, markets make money pretty much 75% of the time if you look at it on an annual basis. So with that understanding, there's only 75-25, meaning that if I put this money in as fast as possible, lump sum investing is superb. Mm-hmm. I mean, it's great. Why wouldn't we do this? But the problem is you're worried about that 25%. because that 25%, if this was catastrophic, meaning the market had a bear market pullback or a 35% pullback like we experienced with this pandemic in 2020, that would be horrible.
The emotional pain of that would be significant.
So you have to have a threshold of pain to understand what is an important decision and what is, who cares, just, hold your nose, squeeze the trigger and go. Because there is, and that's why I always try, it really depends upon what your net worth is. But I can give you some general guidance. If you've sold some land and it's, multiple six figures, maybe even seven figures, that's the type of lump sum. This is once in a lifetime money. I'm worried about that 25%. Sure. So I'm probably going to dollar cost average that, and I'm not going to do it longer than 10 to 12 months. Mm-hmm. We've done the research that really 10 months is about how long you want a dollar cost averaging strategy to go. Anything longer than that, you do run into that opportunity cost being too expensive that it overwhelms the benefit of dollar cost averaging. However, if this is something, say you're worth $1 million, you're seven figures, and you come into $20,000, $25,000, that shouldn't be dollar cost average. That should be just lump sum. Go ahead and make it happen. Do it. If you're somebody who's only worth $150,000, maybe getting $25,000, that's a much more material thing for you. Maybe you do that over 3 months.
I just made up a rule of thumb. Can I share it?
Yeah, sure.
I haven't vetted it. I made this up on the fly, so take it for what it's worth. I think 10% of your total portfolio value is probably a pretty decent threshold. So if you have $1 million portfolio and you have a $100,000 lump sum, perhaps dollar cost averaging makes sense. Anything less than that, perhaps investing all at once makes sense. So on and so forth.
I think what I would, and I haven't back tested this either, but I would probably want to have a threshold as long as you're over like 250,000 or three. There's probably a because I don't want somebody if you're only worth
10,000
brand new and you've got $10,000 invested. I don't want you saying, hey, that $1,000, man, we probably ought to spread that out over 6 months. No, that's there is a threshold there, but I think you can understand the logic. Follow the purpose and the why of this guidance is we're really dollar cost averaging a lump sum is more to protect you when it's once in a lifetime type money that it's so important that it's not worth that you don't want to run astray of that 25% of the time they could get beat up.
This is not related to this question, but here's a second question I'm going to add on. Nobody asked this, but I think it's so interesting that we ought to talk about it. A lot of times we hear people asking about lump sums. I don't want a dollar cost average into the market. Well, I don't know what's been in the water, but I feel like lately over the past year, so I've had a lot of executives that have come to work with a firm who have like very large concentrated positions in stock that's done really, really well. They work for a company and either their employer matches in that company or they had RSUs or whatever, and they have very large positions in a stock that has done tremendously well and, in their opinion, is likely to do pretty well going forward. Well, one of the things we say is, hey, you're over-concentrated. Your human capital is in this stock as well as your financial capital. Your human capital is in the company as well as your financial capital is in the stock. There's a lot of risks that exist there. However, it's a pretty good company and it's done pretty well. It's continued to do well. Just like we dollar cost average into the market, into investments to kind of control the behavioral piece, one of the things that we can do, and I feel like we're doing this for a lot of clients right now, is you can actually dollar cost average out of a position. And I think a lot of people don't talk about that. They think, oh, well, I've got Tesla and I've made so much money and I'm up 1,000%. And wow, when do I sell it? Well, it doesn't have to be an all or nothing. You can pick a time certain period that will remove the emotion from the decision. Say, you know what? This is how much exposure I want to have. This is how much of the stock that I own. I'm going to sell X amount of dollars of the stock every month until I get down to this amount. Well, what's beautiful, if the stock keeps going up, it's just going to stretch out your timeline. If the stock goes down, it's going to accelerate your timeline. It allows you to remove some of the motion out of the equation.
I like it because it's systematic. Mm-hmm. I think that's a big part of what we try to help people work through. Just as Bo said, emotionality. We know that wealth building, a lot of it is behavioral. You fighting those fight or flight instincts, and that's why I like sometimes. That's why I think analytical people love us. Is that we create systems to overcome some of those human concepts and human elements that cause us to not be the most rational decision makers.
I mean, if we were all rational, we'd all be perfectly healthy, perfectly in shape, and tremendously wealthy if we were all rational. Clearly, we are not. This next one is from Joseph. Joseph said, should my emergency reserves be 3 to 6 months of saving to cover my necessities only or my previous monthly average spending? For example, I'd be spending a lot less per month if I lost my job. I'm going to start this one. I want to see if any of this triggers. Here's my thought on that. I recognized that when I got married, my preferences for consumption and saving spending behavior affected someone else, right? And so I recognize that while I think if I were to lose my job and I had to go live off of ramen, I could probably do that and things would be okay. However, if something like that were to happen, and I feel pretty confident that I could secure employment in the next 3 to 6 months, do I want to have to create that type of burden and strain on my family, or would it be more appropriate for my 3 to 6 months to actually cover our current lifestyle so that we did not have to decrease, so it wouldn't be such a shock to the family unit, and add increased additional stress? So I think, Joseph, your thinking is right. Yeah, if I lose my job, I'm probably going to spend less. I'm probably going to cut back, and I think we'd all naturally do that. I still think behaviorally my goal would be to save the expenses for my current lifestyle so that when drastic things in my life change, I get to choose what levers and knobs to pull, and I'm not forced to pull those knobs when maybe there are other things at play.
I like for planning purposes to use what you actually spend because, look, it's going to be more conservative because that's what an emergency fund is there for, is to get you through rough patches. So maybe 3 months of living expenses actually goes a little bit further than 3 months if you base it off of what you actually have been spending during good times. I think what is more important when I'm thinking about cash reserves is that you've got to, and we talk about this all the time as well, is you've got to isolate some additional decision-making components, which is, are we a one-income or are we a two-income household? If you're a two-income, that actually gives you a little more latitude to swing it back closer to 3 months versus 6 months. You also have to ask yourself, and Bo alluded to this, how hard would it be to replace my job? If I'm very specialized and I have to actually move, it might take months and months and months to replace my income. That's going to push you further out on the 6 months versus if you know, hey, there's a competitor down the street that would love to hire me. I get called by headhunters. I could go have a job next week if I wanted to. That pushes you closer to the 3 months. Those decision elements will also come into play. So remember, how many income sources do we have in the household? How hard would it be to replace the income? Because ultimately, an emergency reserves fund, it's called a rainy day fund for a reason. Right. This is when things go bad, when things go as unexpected, you will be taken care of. So respect that and make sure you're taking into account all those variables.
That was a great question. This next one is from JR, or maybe it's JR. It's Podaraki.
Maybe it's Jur.
It's Jur. Okay, this is what he or she said. My workplace offers a 403B and a 401A. 401A is only funded by the company, not the employee. This is where the question is. Is it wise to make the 401A more aggressive, because that comes from the company, than the 403B? Are there any tax implications? P.S. also have a Roth. I think this is the question they're getting at. Should I think about how aggressive or conservative different accounts in my portfolio are? I don't know that I would delineate between 401A and 403B, but
there is a clue there, and I know where you're going with this, is that first thing, when I hear that it's all employer funded, here's a little secret, guys. No matter what you elect with your employer plan, whether it's a Roth or whether it's traditional, you know, your contributions, if it's Roth, are growing tax-free. You don't get a current year deduction, but you get all that growth without paying taxes on it. If you go pre-tax, you get a current year deduction. It's great in that aspect, but you are going to pay taxes when you start pulling it out at some point in the future. But there's a constant going on behind the scenes. Your employer's contribution, no matter what your election is, will always be pre-tax.
Yep.
And the big reason, your employer, they not only want to see you be financially successful, but they want that tax deduction.
Absolutely.
They definitely want to get a reduction of the income taxes they pay by giving you this benefit. And the way the deal from the government is yeah, we'll let you take that deduction, but it's going to go in pre-tax. So when I hear somebody say that their employer, in this case it's a 401A, is funded solely by the employer, we know that that should go into, if we talk about tax location. And remember, tax location, we're talking about the 3-bucket strategy.
Yep.
We're talking about tax-free, which is your Roth. That's top of the food chain. We're talking about tax-deferred, which means, once again, traditionally, you're taking a tax deduction now, but you will, when you pull the money out later, have to pay ordinary income taxes on it. That's another bucket. And then bucket 3 is your after-tax or your bridge account. It's a brokerage account that, once again, you're investing, but it's going to be very liquid and very easy to get a hold of. We've discussed this in a lot of different ways, but when we're talking about tax location, we know employer contributions are going to be tax deferred. When you get big enough that this should matter, you're probably going to want to put fixed income and other things that pay ordinary income taxes in that bucket. So that might be somewhat more conservative. Yep. You want to put growth assets in the Roth. You want to put dividend paying and capital gains, as well as things that maybe you will be taking a loss on in the after-tax account. All this stuff's important. And I always feel guilty, though, when I give this, because this is where it gets complex to the point that you might need a financial advisor or graduate through the abundance cycle and work with somebody, because this is exactly what we help clients work with. I would tell you, though, if your accounts are less than a few $100,000, though, I don't know that you should be focusing on that. I think you should be focusing on doing an index target retirement fund and just get the behavior, get the assets in there. And you know, because that's what's more important, is building your army of dollars versus getting into the minutia of tax location.
Yeah, you know, I think about, like, we talk about the financial order of operations. I even think, you know, in terms of this order of operations, asset allocation matters first, asset location matters second. So I'd make sure the portfolio is right for, like, I wouldn't just put, like, if I just have really crummy fixed income investments or ordinary income investments inside my 403B, I might not take advantage of them simply for the taxes. I care more about the allocation, make it make sense, and then I care about the location. I thought that was great.
And I think savings rate sits on top of that.
Absolutely.
And size of your assets. Before we even get into the details of asset allocation and asset location, you gotta be building the army of dollars.
Let's do one that's controversial.
Uh-oh.
You want to do that?
Well, when we think of controversy, well, of course, the Money Guy Show.
This is from Andrew. He says, you often say fees are the one thing that can be controlled, but you recommend target date index funds. They have more fees than the S&P 500 index fund, which then is the way to go. So you guys say, hey, you can control your fees, but an S&P 500 index is cheaper than a target date retirement index. Should I just do the S&P, or is it okay to pay more for the target index?
Well, I think this is interesting. I was just in an index target retirement fund recently, like a Fidelity Freedom Index. The internal operating expenses for that index fund were 0.12%. Guys, that's pretty daggum cheap. Now, look, he's right. I just could go buy the S&P 500 fund through Fidelity, and it would probably be like 0.01%. Yeah, it's you know, it's essentially, that's not even 20%. I mean, it's like a tenth of the cost.
That's right. So
that seems great, but we're getting to the point where we are splitting hairs. There's a huge difference when you're paying internal expenses of 1.5%, like I've seen on managed funds, or even 0.75%. But when we're getting down where we're talking about a dime for 1,000, I mean, I think the benefit of their asset allocation is more valuable than that 10 cents. I mean, that's where, because we hear the things. Look, you know, if you're paying an extra 1-2% a year in fees, that's going to have a tremendous impact on your long-term performance. But I think that what we're talking about, remember, what an index target retirement fund does for you is you have to only answer 2 questions. How much can I save? When do I need the money? You don't have to do anything else, because for that dime, they're going to essentially go out there. You're going to be aggressive while you're young, and then every year, without you thinking about it, it's going to get more and more conservative. So you focus on the most important thing, which is going to create wealth for you, which is building your army of dollars. We already know when you get to be $500,000, you know, $600,000, you're going. This thing's going to get so complicated. You're going to say, "I need a co-pilot," and that's when you'll graduate to through the abundance cycle. But the most important thing when you're building that foundation is just getting the behavior in there. So don't sweat the small stuff. Because this is like somebody who has $1 million worried about should they go to Starbucks and get a coffee. I mean, it's an important. It's not
going to break the
There's
plane.
money, discipline, and saving money is important, but worried about a nickel on internal expenses is probably not going to make a huge difference.
So I think that was a great question. You know what? Here's just something to remember. sometimes it's okay to pay a little more. I know it's crazy to hear us say that, but Brian, you live in such a place that a bicycle would get you to and from work just fine, and it's probably cost less than your car cost. But it's probably okay that you drive a car every day. It's probably okay that you made that financial decision to spend a little bit more to get something a little bit better, to get something a little bit different, to get something that gets the job done a little more effectively.
I do love riding my bike to work.
You
I
know
actually
what?
do it. But here's there's a great analogy, because here's the problem with the bicycle. The bicycle is actually more fun than the car on good weather days. The problem with the bicycle is there's no seats for my daughter when I take her to school. So it's
put her in the basket.
So there's no way to make it work. So I see it's a point well taken.
Guys, thank you so much for allowing us to come in. Hopefully this has been valuable for you. Hopefully you took away the 5 life lessons that we've learned from GameStop that we've tried to share with you. As a reminder, we're going to keep putting content out there for you, keep adding value to your financial life. If you've not gone out to our website, go to moneyguy.com/resources. Check out the plethora of free resources we have out there available for you. If you haven't had a chance to go check out our wealth management website, go to aboundwealth.com. You can see some of the folks that we get to hang out with on a day-to-day basis and some of the folks that you will meet when you come to Franklin, Tennessee and do your tour of the office.
Hey guys, and don't forget, subscribe on YouTube. You know, look, we're over 100,000, but it doesn't mean we're done. So we invest in you, so we ask you to invest in us. Give us a subscribe. Give us some smashing that like button.
Oh,
I was going to
look
try
at
to,
you.
whatever. I know we'll get some troll comments on that, but by the way, everybody says smash the like button.
Everybody. It's not one guy. It's everybody.
But maybe maybe Graham did start it. Who knows? But we'll give him credit. Just go ahead and invest in us. We're trying to love on you, give you all the advice so you can complete the abundance cycle. Thank you, thank you, thank you. Money Guy team out.